Hi everyone, I thought I'd pop on this crazy afternoon. You didn't think the government were going to make any more U-turns, and they've gone and made more U-turns, so what a crazy day. But I thought I would just pop on because I've had quite a few people ask me this week, is it worth me, when I'm remortgaging, going on a tracker rather than trying to fix at these crazy rates? And I just wanted to sort of talk you through the pros and cons. There's no right answer, because what this comes down to really is your personal circumstances and your appetite for risk. So I can't tell you what to do, but I can talk you through the pros and cons so that you can make an informed decision. So let's think about the options. So fixed rates at the moment, we're talking, it's not really much difference between sort of buy-to-lets and HMOs with sort of bricks and mortar valuations in a limited company. So let's kind of go around down that route for one of a, just as an example. So we can do sort of 2-year fix. We've got sort of 5.09 or 5.29 with a 2.5% fee, which is quite hefty. We've got 5-year fixes around the 6.5%, and we can kind of do commercial valuations for something quite similar as well, sort of 6.75 with its own sort of situation. So that's where we're sitting in terms of a fixed rate. Trackers are looking at sort of 1.75 or 2% above base, which at the moment is going to put you at sort of 4.25. Again, that's limited company, buy-to-lets or HMOs. So what should you do? Obviously, that is lower than the fixed rates are sitting at the moment. What are the risks? So what you've really got to think about is where you think the base rate's going to get to, and nobody really knows the answer. There's speculation pre the mini budget, which I feel like is the wrong word to describe the budget, given its impact. But before the mini budget, they were talking about raising the base rate by about 1.75 on the 3rd of November. The U-turn of the mini budget, now they have U-turned, and obviously they've now U-turned again. So will we see a rate increase of that much? I don't know. We'll have to just wait and see. What we need is a bit of stability long term. Whether we'll get that, I don't know. But where do you see the base rate in a year's time or 2 years' time? If you think it's going to get to sort of 3-4% and stay there, then it might be worth taking the risk. If you think there's a chance that it might go up to 5.5-6%, then potentially not. So then that's one thing to think about. The other thing to think about, and I think this is underrated, and I think especially with all the other unknowns that we've got at the moment, stability and guarantee on your mortgage rates, I think, is really underestimated. So yes, you can fix it. Yes, you could fix it at something which you think is too high, that possibly could come down, and all those other things. But what it does allow you is stability, and you can then choose how long you want to guarantee that rate for. Is it a year? Is it 2 years? Is it 5 years? Is it 7 years? And you will always pay for that certainty. Banks will always overestimate what they think is going to happen, because that's the way that they work. They don't want to underestimate and risk making a loss. But you will pay for that guarantee. But what does that allow you? You know that your costs in one aspect are fixed for the next 5 years. And particularly if you've got an HMO or service accommodation where you are paying for the bills, and you've got no certainty over that, it means that you have got certainty over your mortgage payments. So how important is that to you? And things that you need to think about when you think about that are, what's your outside income? Is that likely to change? How much spare income do you have each month? And again, what your long-term plans are. If you've got a full-time job and you're earning, a decent amount of money, whereby this is kind of a nice to have, then that is less important to make an amount of money each month. If this is your main income, then it's more important, and that's again another balance to think about. So really it comes down to what you think is going to happen. The other thing I suppose to think about is, if rates do go up considerably, and what point would you say, I can't do this anymore, I need to fix it? And what will rates be at that point? And then you're then fixing it potentially at a much higher rate for a period of time from that point. So as I said, there's no right or wrong. It's always going to come down to your personal circumstances and your attitude to risk. I do think that we need to be careful, because the potential pitfalls of a variable rate are far greater than the potential pitfalls of a fixed rate. The worst that's going to happen with a fixed rate is that rates come down and you're paying a little bit more than you're expecting, or that you should be. But you've priced it so that you're okay. Whereas in a variable rate, you've got the potential that there is no cap on what those mortgage rates could be, and you have got to take that into account. We could end up in a sticky situation, but if you're happy to take a risk, it's an informed risk, you know what the pitfalls could be, then maybe that's the way to go. And if you do genuinely think this is a short-term issue and maybe next year things will have calmed down, then maybe that's something that you want to do. Just the other thing to think is the disparity at the moment between the base rate and what people are offering on fixed rates is large, and the reason it's so large is A, the base rate is still quite low, and there's always a bigger margin when the base rate is low, and B, lenders are predicting what's going to happen in the next 2 years, 5 years, 7 years. It's not about what's happening now, and they're pricing in that potential increase. If we can get to a point where the base rate stays where it is for a period of time, the markets calm down, hopefully we have a Prime Minister who's been in office for a period of time and people trust. Hopefully we've got a Chancellor that is the same. Who knows what's going to happen with that for the next couple of months. But if we've got a period of stability, then the margin between where the base rate is and what lenders are offering will reduce. So there is that potential, but it's just a case of how long it's going to take to get there. And I suppose that's the million-dollar question that none of us know the answer to. But there's my food for thought this Friday afternoon. And obviously if you want to chat anything through, then give me a call. Have a good weekend.